According to the Bureau of Labor Statistics Consumer Price Index, the average inflation rate of the US dollar has been 2.52% per year since 2000, with a cumulative price increase of 77.54%. The US dollar in 2023 can only purchase 56.180% of what it could in the year 2000, while the net wealth of the top 1% of households is increasing at an average rate of more than 6% per year. These statistics highlight how inflation can impact low-income earners by disturbing their purchasing power quicker while appreciating the investment assets of the rich. Inflation is an increase in prices over time that decreases the buying power of money. In other words, as inflation occurs, money gradually loses value and buys fewer items than before. This decrease in value affects both individuals and businesses and can impact the process of building wealth. Because banks respond to high inflation rates by raising interest rates, low-income earners are saddled with debt and can't afford to maintain a balanced standard of living.
Overconsumption is a cause of inflation when an economy overheats, and then the use of interest rates is useful for that. But this is a commodity price-based inflation.
Interestingly, inflation can redistribute wealth from creditors to debtors and ultimately increase the wealth of the rich. In this video, we look at 6 clever ways rich people make money with inflation. The 3 causes of inflation are demand pull, cost push, and inflation expectations. Demand pull occurs when demand goes up and surpasses the supply of sustainably produced goods and services. It forces an increase in prices as businesses cannot keep up with demand. It also occurs due to consumers having more buying power, the government spending more money on welfare programs, and banks lowering interest rates. Cost pull inflation occurs due to an increase in production costs. When the overall supply decreases but demand remains the same, both prices and inflation rise. That is, inflation is pushed upward. Factors such as a rise in labor costs, disruption in the supply chain, high energy costs, and import inflation contribute to cost-push inflation. Inflation expectations are predicted future rates of inflation that people, businesses, investors, and policymakers use to make price decisions.
Cost-push inflation? Yes, that comes from the supply side. So something happened in the supply side of the economy that caused cost-push inflation.
These predictions are important because they shape inflation outcomes and influence price changes. They influence how people and businesses behave now to avoid paying lots of money in the future. 1. The first way rich people make money with inflation is by leveraging debt to create wealth. Leverage is borrowing money to improve the potential return on investment. They are investing with less of their own money and borrowing more money to increase returns. Debt can be used strategically during a recession to build wealth. The rise in inflation significantly decreases the value of debt over time, and that is good for people who borrow using fixed interest rates, as this allows them to pay the debt that has less value on what they initially borrowed. Investing in stocks, real estate, and commodities can double the return on investment, as these assets tend to appreciate during inflation. While leverage can drastically increase returns, the opposite is also true. So, rich people thoroughly understand the risks involved and consider their risk tolerance and affordability. Warren Buffett, Donald Trump, Carl Icahn, Richard Branson, Sam Zell, and Elon Musk are among the many successful entrepreneurs and investors who use the power of leverage to accelerate their businesses and returns on investments. Warren Buffett borrowed capital to invest in undervalued stocks in the textile industry earlier in his life. Elon Musk used debt to pay for projects such as the invention of Tesla. The possibilities are endless when it comes to using leverage to build wealth, and it doesn't just stop at taking other people's money. Leverage is also a powerful personal brand. They also invest in real assets to make more money during inflation. Real assets are tangible and valuable because they generate revenue and appreciate over time. They include real estate, commodities, natural resources, infrastructure, and collectibles. These assets tie to inflation in several ways. 1. In real estate, Property value tends to increase with price movement because of factors such as the rising cost of labor, land, and materials. Real estate companies also tend to have high operating margins and low labor costs, with some commercial leases tied to explicit rent escalators. 2. Infrastructure developments are part of calculating consumer rates as they form part of project utility costs and affect the utilities rate. Commodities are grains, livestock, and precious metals.
Real estate. Start to study the marketplace. There's always a deal to be had in real estate. Whether it's outside of your area, whether it's another city, whether it's another state, start to look for undervalued properties that you can obtain with very little down.
They serve as direct inputs to inflation measures as their prices respond to economic forces like employment, inflation rate, natural disasters, etc. They have more advantages because they offer intrinsic value, have a positive correlation with inflation, offer more benefits from rising rental income during inflation, have pricing power, can provide diversification benefits, and have a tangible value because they are seen, touched, and used. Rich people also have a diversity of assets. Diversification is a time-tested financial plan that produces significant results. Because the influence of inflation on various asset types differs, diversification across financial instruments and asset types such as equities, debt, gold, and real estate protects their portfolio during difficult times of inflation. Diversifying is a powerful strategy that reduces risks and preserves wealth. When inflation decreases the buying power of money, having multiple assets ensures that their investments maintain or even increase in value, helps their portfolio spread risk across assets, and limits the impact of a drop in a single investment. Diversification helps the rich manage risk and increase their chances of successfully navigating an inflationary economy. A diversified portfolio increases the ability to adapt to changing market conditions. When inflation affects one asset class, other assets in the portfolio can provide stability or growth. Assets like stocks and commodities perform well during inflation and can increase their ability to adapt to changing market conditions. These assets can preserve wealth by producing higher returns that outperform inflation. Diversification also reduces their vulnerability to shifts in monetary policy by helping them hold onto assets that perform well during different periods of inflation. Diversification helps wealthy people navigate market volatility and inflationary pressures by reducing risk, preserving wealth, providing stability, generating income from multiple sources, reducing concentration risk, and offering long-term growth potential and protection against economic uncertainty. 4. Capitalizing on rising interest rates. Inflation is the general increase in the prices of goods and services in an economy over time. Increased demand, supply constraints, changes in production costs, and other factors can all contribute to it. Interest rates represent the cost of borrowing money or the lender's return on investment. The country's central bank determines the interest rate and how it impacts general economic circumstances.
Yes, so it's got nothing to do, and so raising interest rates actually has an end result of just harming even more people who are already squeezed. So personally, I would love the Bank of England to refrain from that.
The two main types of interest rates are the nominal interest rate and the real interest rate. Nominal interest does not take inflation into account. It is the original interest rate on loans and savings accounts, and the real interest rate is the nominal interest rate adjusted for inflation. It shows the real buying power earned or lost on an investment or loan after adjusting for inflation. Real interest rates provide a more realistic assessment of the cost of borrowing or the return on savings. During times of high inflation, central banks can choose to maintain low nominal interest rates, and because borrowing costs are low, this can increase borrowing and spending. However, this can decrease the value of savings and investments. Central banks can raise interest rates to combat inflation when it becomes too high and threatens to destabilize the economy by reducing borrowing and spending to cool down the economy and lower inflation, especially during hyperinflation. During a recession, central banks lower interest rates to boost borrowing and spending and promote the economic growth of investment and consumption. In a low inflation situation, central banks keep interest rates relatively high to cut them if necessary during economic downturns. Maintaining high interest rates, on the other hand, can limit borrowing and spending. Rich people earn most of their money from interest. Borrowers have more money to spend when interest rates are low, and rich people make money when interest rates rise. They use bonds and fixed income investments that they sell to buy new ones when interest rates increase. They also use floating rate bond coupons and invest in real estate that generates income or real estate investment trusts. They also opt for dividend-paying stocks and high-yield bonds and use leverage to magnify their investment returns. High-yield bonds are one of the investments that offer quick returns because of the high risks involved. 5. Creating and capitalizing on business opportunities. Businesses can grow during inflation by raising prices and increasing revenue for the same products or services. During this period, the unemployment rate increases, and most companies are willing to let go of their staff members, providing a bigger pool of talent and skills for those that wait for the transition. There is also an increase in business opportunities in some sectors because of changing economic dynamics and consumer behaviors. These sectors include commodities, natural resources, real estate, construction, infrastructure, energy, finance, healthcare, education and training, debt collection, and asset recovery, to name just a few. Because most wealthy people are entrepreneurs, they strategically identify opportunities in these areas and invest for profits. Entrepreneurs capitalize on these opportunities by identifying gaps in the market, studying changes in consumer behavior, and analyzing emerging trends. They then develop solutions to address these gaps and make money. They also adapt to the changes by coming up with cheaper ways to boost production and align with the change in dynamics. By filling these gaps in the market, they can create employment, remain competitive, generate wealth, and build economic resilience. Companies like McDonald's, Coca-Cola, Amazon, and Pfizer perform well during inflation because they can adapt to economic conditions and customer behavior. 1. Investing in income-generating assets. Income-generating assets include dividend-paying stocks, bonds, especially those with regular interest payments, real estate properties, rental income, real estate investment trusts, REITs, and dividend-focused mutual funds or exchange-traded funds, ETFs. They can be used as a regular source of income as they generate cash flow. They are also good because they preserve purchasing power and maintain financial stability during inflation.
And I would think it would be desirable to have a fund like that, just top of the head, maybe 50% high-grade corporates and 50% treasuries and other government-backed mortgage, 50-50, just for the fun of it. Those corporates are now only about 30. So a better representation for a higher yield, and higher yield will lead to a longer return, holding everything else equal in the long run, as we all know.
These assets protect investors against inflation as they adjust their value accordingly. They are also resilient to economic shocks, as their decline in value does not affect the income generated. The efficiency of income-generating assets in battling inflation depends on their type, qualities, and the current inflation rate. Warren Buffett and Robert Kiyosaki are among the individuals who strategically built investment portfolios that continue to generate steady income streams. Warren Buffett built Berkshire Hathaway, a conglomerate with a diverse portfolio of businesses that made him wealthy. Robert Kiyosaki used real estate investments and other income-generating assets like content creation to build his wealth. Let us recap how rich people make money during inflation. They leverage debt to create wealth, invest in real assets, diversify their investment portfolios, capitalize on rising interest rates, capitalize on business opportunities, and invest in income-generating assets. You can also apply these strategies to thrive in tough economic times. Remember that most of these strategies are risky, so take the time to learn more and empower yourself. If you have made it this far, please hit the thumbs up and don't forget to hit the subscribe button and notification bell to get an update when a new video is uploaded. Also, check out previous videos to get more insights. Until next time,